Friday, Halloween afternoon. Instead, lots of stuff going on with the Fed's repo facility. Now, we've been talking about escalation for the last, several weeks, almost a month now. It really goes back into September with Tricolor. Kind of set aside the huge, or the use of the Fed's repo facility back on September 15th, kind of swept that as aside as just, the seasonal bottleneck. Then, of course, the quarter end, you expect a little bit of, illiquidity, window dressing that happens. But then you get to the middle of October and suddenly things are going haywire now. We've been talking about the Fed's repo facility. The marketplace is borrowing from the Fed more and more. I did a live video a couple days ago. We talked about this as well as what the Fed's explanation is for all this money market stuff. And that was simply, hey, it's got to be quantitative tightening. What else would it be? So the Fed said, we're gonna wind down our balance sheet runoff. We'll terminate on December 1st. Nothing to see here. A bunch of technical stuff and you could kind of see where they were coming from. You understand? I mean, as we talked about in the live video, Steve and I talked about this too. I mean, they were not huge numbers before we got to today. I mean, just a couple billion here or there. They kind of escalated to 10 billion, not huge in the grand scheme of things. Even the SOFR rates that we've been tracking, money market rates, effective federal funds rates, in the middle part of the Fed's range, nothing huge there. SOFR rates above the Fed's upper limit, that was a little bit concerning, but you could see where the Fed was coming from saying, it's a bunch of technical stuff. There's a little bit of volatility. There's normally volatility in money markets. We'll wind down our QT over the next month just in case, and then nothing much to see here. And then today hit. Today was right from the get-go escalation. And then in the afternoon, this is something I talked about a couple of days too, afternoon repo. Suddenly the Fed's repo facility is being used in the afternoon. It was a little bit, 76 million the first day, a couple of days ago. Then it was a billion or so, a couple of billion yesterday. I think it was 4 billion. And then today, I'll save that for a couple of minutes here. Let's get into the slides, but huge escalation in the Fed's repo. You can't blame it on month end either. Yes, it's October 31st, but month end is not a thing in money markets. So this isn't just because of October 31st. There's definitely something else going on here. We'll discuss exactly what all that stuff is. Is the Fed going to have to end its QT far earlier than maybe it wanted to? Because that's what happened in 2019, if you remember already. Same thing, same setup. In fact, a lot of similarities to 2019. That's really the point. That everybody's missing with the Fed's, with the focus on the Fed and bank reserves and everything else. But instead, like I said, we got huge increase in repo facility usage. And it's not Halloween around here, it's Eurodollarween. And once again, the Eurodollar system is reminding us why that's the case. So where we were before, there's a chart of the repo facility usage. You can see it's escalating since the middle part of September. The Fed says that's bank reserves. We're running off our balance sheet, falling bank reserves thanks to quantitative tightening. I mean, Jamie Dimon even said, hey, there's lots of cockroaches here. And you can see the apparent correlation with some of those cockroaches. And so you have to wonder here, I was getting a little bit ahead of myself here, but you have to wonder if instead of October 31st, what's the big deal about today? Maybe it's going into the weekend. Will there be some kind of news coming out on Monday? Is there something that money market participants are thinking about over the weekend that has disturbed a lot of people? So here's where we are today. Huge increase in the Fed's repo facility. Like I said, in the morning, we had morning repo, 4.4 billion in U.S. Treasuries, almost 16 billion in mortgage-backed securities. If that was it, if it was just a morning repo, that would have been way more than enough to say something is going on here, because that would have been higher than on the chart than any of the other ones so far. 16 billion, almost 20 billion, actually over 20 billion. That would have been an escalation all its own. But then look at the top part of that chart, or top part of the table here. The Fed's afternoon repo, 25 billion in treasuries, the biggest one yet. And then another 5 billion borrowed on mortgage-backed security collateral. So you're talking about just a little bit over 50 billion total. So we went from, a couple of billion here or there to then, okay, 6, 7, 8 billion, maybe 10 billion. And then you see over the last week, it's almost regular now. And then we jump from a little bit over 10 billion to 50 billion in basically a day. Yesterday was even calmer than it had been previously. So you thought, okay, things are calming down. And then Friday hits and you wonder, what the hell is happening here in the marketplace? Because this is going way beyond what Powell was saying a couple of days ago. And it's obvious the Fed has been caught off guard by this. Otherwise, they wouldn't have just kind of brushed it aside. Now, money market rates. This is the part I hate about the bureaucracies. Markets don't wait for anybody, yet we have to wait for the Fed to calculate money market rates and taking their own sweet-ass bureaucratic time. We won't know what the SOFR rate is until Monday. We won't know what the effective federal funds rate is until Monday, even though we've got all this stuff taking place on a Friday heading into the weekend. So the SOFR rates, as I mentioned, a couple basis points above the federal funds upper limit. And let me say again, the Fed does not target repo rates, even though repo is the vast majority of money markets and wholesale markets out there. And the repo rates that we're talking about here with SOFR, they don't cover the entire repo market either. That's just a domestic part of it. They don't deal with offshore transactions either. So this is one limited part of the system. SOFR is at least more representative of repo transactions that take place than something like federal funds, which is just, not much happens in the federal funds market. But since the Federal Reserve targets the federal funds rate, that's the one they focus on to communicate their policies. They don't specifically target the repo rate. However, after 2019, they understand, at least they were forced to understand, that if there's volatility in one part of the money market, and repo is a big part of the money market, if there's volatility and tightness in that part of the money market, there's very likely to be volatility and tightness in other parts of the money market as it spills over, especially when we're dealing with risk aversion rather than something like just benign bank reserves and quantitative tightening that isn't actually tightening. So you see the repo rates that's represented by the SOFR benchmark that are higher, they're elevated, they're more volatile than they should be, though the Fed made the case that the volatility should be normal under money markets that are adjusting to what they call from abundant reserves to ample reserves. And that's how they've categorized this as nothing more than a transition from abundant reserves to ample reserves when it's really about risk aversion here. And that's the question we need to ask is what's really the risk that everybody's trying to avert. But as of yesterday, the SOFR rate was, because we have to factor the Fed's rate cut that became effective yesterday, the SOFR rate was about 4 basis points above the upper limit of the federal funds rate. So a little bit below where it had been on Wednesday or actually Tuesday. So it came down a little bit. And we have no idea what the SOFR rate's going to be today because, like I said, the Fed won't calculate it until later. And remember what Jay Powell said. He actually did say this at his press conference. He did admit that though they're downplaying this as nothing more than the transition to ample reserve regime, because everything's always about bank reserves with the Fed and, of course, therefore the financial media, he did at least admit that the recent market pressures accelerated the Fed's timetable to end its balance sheet runoff called quantitative tightening in not exactly, but very similar manner to what happened in 2019. The Fed had no plans to end QT, and then we started to see more and more of these same types of repo market, effective federal funds rate and federal funds market volatility that forced the Fed to prematurely end its QT back then too. So there are a lot of similarities to 2019, including the fact back in 2019, we were going through the recession scare in the summer of that year too. Just a month before, not even a month before, the repo mess that happened in September 2019, you got the inversion in the yield curve for the first time. So it was relatively early in that recession scare process. But either way, you had risk aversion, you had problems in global marketplace, global questions about the global economy, lots of similarities to today, even though the Fed was still talking about inflation fears and inflation pressures, and the Fed had started cutting interest rates by then as well. Not that any of that made any difference. Now, zooming in a little bit here, as I went over on a couple days ago, what was that, Wednesday? You could see the shift in the money market rate regime. You had SOFR rates that were relatively stable around 5 basis points or so above the lower limit of the federal funds target. And then you get into July as the US dollar exchange value starts to move higher. Suddenly repo rates they don't have that bottom part of the range there. They start to elevate a little bit. And then of course you get to the back part of August and into September and into the bottleneck on September 15th. Suddenly the SOFR rate's above the federal funds upper limit. And then you get into October as the cockroaches start to show up more and more. more through the shadow markets. Now you have more volatility in SOFR. You have more usage at the Fed's repo facility. And I think you can see where we're going with this. It's not about bank reserves in the Fed. In fact, as I pointed out back then, don't want to skip this here. The effective federal funds rate, like I said, is kind of meandering higher. It's about in the middle part, lower middle part of the Fed's range, which is one reason why the Fed said, we're going to take our time with QE or QT. We're not going to end it in a rush. We're more looking at this sort of like a technical matter than anything else, because the federal funds rate, which again doesn't really matter, but for them it does, hasn't really behaved in this sort of volatile way. But just looking ahead a little bit here, you have to wonder if that's all going to change based on what's happened today. What is the SOFR rate going to come out as? What is the federal funds rate going to come out as? The effective rate. What is going to happen on Monday? Are we going to see a repeat? Are we going to see even further escalation? Does that lead to the Fed saying sometime maybe next week, if they continue to have relatively unstable money markets and high usage of the Fed's repo facility? And by the way, the Fed's repo facility is not working. It's supposed to keep money rates from being this volatile, and it's not actually doing that. But if we continue to have these same levels of problems moving into the next week, you have to wonder if the Fed's going to have to accelerate even more its schedule to end its balance sheet runoff. So like I said, they want to blame bank reserves, and you can see the level of bank reserves is going down more recently. But there's twice as many bank reserves today as there was in 2019. You can't use the level of bank reserves to somehow explain what's going on in the repo markets, especially since, like 2019, what happened in repo is simply corresponding with the risk aversion and tightening that we've been talking about this entire time. Again, bank reserves have been relatively stable over the last several years, and Powell is just downplaying everything because, look, that's his job to do it. And by the way, they're not expecting this level of escalation because they really believe on some level that maybe this is all just, it's all just pure theater. That what they do is pure theater. But it's easy to downplay this because you don't see the stock market reacting, for example. And everybody, the stock market is soaring. So this stuff doesn't really matter. It's all a bunch of technical stuff in the marketplace. So let's end this review. That's really what I wanted to do, is just review, make sure everybody knew what was going on today so that you understand what might happen on Monday. We'll see what really turns out. But let's speculate a little bit about what we're actually seeing here. Like I said, the word that keeps coming up is escalation. We've been following tightening in money markets, not necessarily these money markets we're pointing out here, but the tightening in the money markets and parts of it that we can see and that we've been watching here at Eurodollar University, really since the payroll report came out in the early part of August, the July payroll numbers, which makes sense because, as I keep pointing out, the payroll numbers confirm a lot of the potential downside in the real economy, which absolutely plays a part in these cockroaches. Because the cockroaches have been undertaking very risky behavior and justifying it as there's no downside in the economy. Jay Powell says everything is just fine, so they take a whole ton of risk. And even as the economy slowed down earlier this year, questions really started to build about labor market, consumer economy, what the shape of small and medium-sized businesses that are laying off workers, all the stuff that relates to the credit portfolios and the credit profile of those portfolios among the shadow bank lenders. And so what we're seeing up to this point is escalating tightness in money markets. That part is uncontroversial. That's the part that even the Fed would admit. In fact, they actually did on Wednesday. There is escalating tightness in money markets. Where we would disagree, the Fed has already said this is just, related to our balance sheet runoff. It's all benign, nothing to see here. We've been saying, look, there's tightening going on in other parts of the money markets that nobody pays attention to, that's corresponding with macroeconomic weakness and concerns about private credit and shadow banks and everything else, even before Jamie Dimon brought up the term cockroaches. So if we're seeing tightness escalate in money markets, you can either believe the Fed that this is all benign related to bank reserves, or you can look at the situation in the real economy and how it's playing out in those shadow markets and how it's causing some of these cockroaches to scurry into the sunlight so that we can observe what's actually taking place. And by the way, as I mentioned before a couple weeks ago, with these cockroaches, what is the common theme in all of them? The common theme in all of them so far is collateral questions. It's either fraud or valuation. Vast majority so far have been fraud. So if you're a money market participant and you've got cash to lend, you've got spare cash to lend, not necessarily reserves, but just cash. You've got a balance with JP Morgan or some other dealer bank. You've got a cash balance and you've got spare funds that you can lend out in repo. Maybe you start taking a little bit of a second look at it. Maybe you start thinking, I don't necessarily want to deploy cash, even on a secured basis, because I'm not really sure what's going on in the marketplace here. There's too much information asymmetry. There's too much opacity. We're not getting any straight answers from authorities, which is exactly what the Bank of England governor said, Governor Bailey, just a little over a week ago. He said, we asked all of our private credit participants and sponsors in England and the UK and said, hey, what's going on in the credit portfolios with you guys? And what did they say? They said, no, nothing. There's absolutely nothing to worry about here. I mean, maybe some rating agencies downgrades or something, but that's nothing to worry about. Don't worry about it. And even Bailey said, I'm getting the runaround here. So the upshot here, let me leave you with this. What we're seeing is, without a doubt, not controversial, there is tightening going on in money markets. And it is incumbent upon me and you and everybody else to try to figure out why that is. You can believe, like I said, the Fed, and it's benign, it's related to bank reserves, or this represents a clear level of escalation because of risk aversion among money market participants. They don't have the cash because there's tightening up going on in the shadows even further beyond what we can see, and that is having an impact, not just in money markets, but in all sorts of places, including the Federal Reserve's policies. Like I said, they even admitted they accelerated the timetable with QT in response to this volatility. And so we had escalation before today, and without a doubt, there was even more escalation today. I mean, getting up to $50 billion out of the Fed, including a huge amount taken in the afternoon. These are all signs of an escalation. And as Steve and I were talking about recently, they're also signs of an unhealthy system and unhealthy economy. So it's escalation, tightening in money markets, that part's taking place, and we got to figure out why that is. Now, specifically why that is, we don't have that kind of information yet, but it does not take a leap of logic here or make a huge intuitive leap to really see Jamie Dimon's cockroaches start to play out in these vast money markets. And if it's like this in the visible money markets domestically, you do have to wonder if it's a little bit more messy and volatile offshore in the money markets that we can't directly observe. So something to keep an eye on, keep thinking about this weekend to see where it goes. Everyone have a fantastic Eurodollarween or Halloween, and I'll see you all again really soon.